Good evening and welcome to StockOdds, Odds and Ends. I'm Dave Singh here with Rob Friesen, trying to get a start on the week ahead here. Good evening, Rob. How's everything?
Not too bad, thank you. We can knock it out of the park here today with some tips for the week and some ideas. What's going on, right? Are you ready?
Well, I mean, the backdrop is it's supposed to be a little bit of a bullish month anyway. I mean, we've got, even on monthly seasonality, Spider should do 2.7% for the month. And there are some sectors that are more risk on, right? You got technology, QQQ, some of the ARC funds, these are in SMH chips. So these are expected to outperform this month. Things like oil underperform. So we've got that strong bullish backdrop to us. But there are some nuances as to what we can be doing or what we should be doing. Maybe you can give us some more insight in that.
I mean, mid-month seasonality did start on Thursday, but I think the problem with it for Thursday was that people were kind of waiting till expiration. So Fridays, I would think, would have been more in line with seasonality starting. So it's in play this week, right? So it's, the 9th, 10th, 11th, 12th through to the 14th business day of the month. And so, we saw Friday a nice launch, and the markets are trying to follow through on that a little bit right now. The Dow Jones Futures are up 0.24%, 76 points. S&P's up 0.32% or 12.5 points. NASDAQ is up 0.54% or up 64.5 points. Russell 0.44%, up 7.60. Now, when I look at what's happening with the DAX, it put in a higher low recently. The Euro Stoxx 50 put in a higher low. Nikkei also put in a higher low and is actually looking pretty strong at this point. The Russell also put in a higher low. NASDAQ 100 put in a higher low, but the S&P 500 did not. It actually had a lower low relative to the previous 2 weeks, as well as the Dow Jones had a lower low relative to the previous 2 weeks. So it looks like there's an appetite for some tech, and we've been talking about that already since the expiration that we had in June, where we saw that appetite start a little bit, right? So we've been about a month with some of that tech appetite. And the same thing applies with the Russell. I've seen some very good performance on some days from the Russell 20 list that we do. They definitely have more volatility and they can move. And so a lot of people are playing the, lower price stocks on those type of days where they see a risk on appetite anyway. Now, the VIX has also dropped back to 25.25. It's slightly up right now, but I mean, it could cycle back. Nothing's written in stone. I mean, lots can change between now and tomorrow morning as well, right? I pulled up a chart of the IVE and IVW. Now, remember we talked at the beginning of the year, it was the second trading day of the year where all of a sudden we saw, on the first trading day of the year, we saw, in performance as if it was going to be a bull market in the techs and everything, and it was totally risk on the very first trading day. But then the second trading day, it was like a whole different world, and they were buying the value and then they were selling the growth. And that continued all the way until May 26th.
Huh.
Since May 26th, it's been sloping down, where the S&P growth stocks have been actually outperforming the S&P value stocks. Now, there have been some spurts along the way, but you can draw a really, really nice trend line from the peak on May the 26th all the way down to where we are now, of value declining relative to growth. So where you see some days where you see some value stocks, but that's not the real story, right? So let's put all the picture together. What's really happening? If the proof is on the tape and people smarter than you and I are calculating all kinds of things, we should see their footprint, right, Dave?
Mm-hmm. Yeah.
Okay, let's look at the commodities for a second. What are the commodities saying? When I look at a monthly chart, okay, to really get a good picture of all the commodities, you notice already June and so far in July that crude had rolled over, right?
Mm-hmm.
Okay, now crude's an interesting story because of all the stuff that's going on. But what about the other commodities? Gold is definitely heading down. Copper's heading down significantly. That's 4 months in a row now since the peak. Copper is a leading indicator regarding economies, and especially globally. And so it's definitely signaling more of the the recession story. The slowdown story is what it's signaling. Silver, similar to gold, 4 months down. The other metals, platinum, palladium, the same thing. Now you've got corn is now 3 months down since the peak. Soybean oil, widely used globally, 3 months down. Oats, too strong. June was a real sell-off in oats. Rice, not as much. It seems to be more of a staple. It's holding up pretty good. Soybeans and soybean oil as the same thing, 2 months down. Wheat, June was a huge sell-off in wheat. And then July is still continuing with that sell-off. Canola, huge sell-off in June. Cotton, massive sell-off in June. Erased literally 8 months worth of rally. Coffee, massive sell-off so far in July, was stable before that. Lumber, you saw the peak back in the summer of 2021, and then we had a lower peak earlier this year, and it's down almost to what would be considered fair value, going all the way back to 2018. So orange juice down. Like when you look at these commodities, the metals especially are affected by a strong US dollar, which we've had up to pretty much here. If I look at, like, it's the monthly super strong still. For June was up, making new highs relative to the last number of years. July's follow through have been extremely strong, as they've been factoring in possibly more than 75 basis points and possibly going to 100 basis point hike. But we just saw it roll over for the last couple of days on the US dollar. So do we have a peak in? Is there more upside potentially? I don't know for sure, but it's really interesting what its impact has been on the commodities, because they're priced in US dollars. So if the US dollar does pull back, yes, some of these commodities could firm up or maybe even appreciate a little bit. But I think the story that I'm seeing is a combination, and it's like everything. You can't put your finger on just one catalyst. There's going to be a number of things in play, and that's the difficulty with macro interpretations, is you got to factor in a lot of things. It's never about just one thing, right? So I think the US dollar impact on the commodities definitely been evident, as well as I think the argument to leaning towards recession. So we've had this debate between inflation and it driving a hot economy, and then versus the recession. And, even we've seen things like lockdowns in China have, impacted some of the commodities and oil as well, right? Now I want to talk a little bit about, the Wall Street constantly creates products, right? And these products, can be useful by traders. They're not really designed for traders or investors' benefit. Like Wall Street doesn't come up and say, well, here, we're going to create a product so that you guys really, really benefit. No, it's more so that the industry can profit from it, right? The managers of the ETFs or ETNs can profit from it. So we have this week launching 8 single stock ETFs. Fairly new concept. We've had multi-stock ETFs, right? But single stock ETFs kind of remind me of single stock futures back in the day. It was many, 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 many years ago. They tried single stock futures, and the volume didn't take. So they haven't really been utilized all these years. But single stock ETFs, I could see a lot more people playing it. For example, Tesla will have TSLQ. So it's Tesla. It's a 1X bear. So instead of buying TSLA, you would buy TSLQ and you would be short Tesla. So instead of having to short it the traditional way, you buy the bear and you're short. So that's a 1X. NVIDIA has NVDS instead of NDVA. So the S is the bear and it's 1.25 times. PayPal has both a bull and a bear. So PayPal S is a bear at 1.5 times, and PayPal T is a bull at 1.5 times. So it's PYPS or PYPT. Then we go to Nike. Nike has NKEQ. It's a bear. It's a 2 times. And NKEL, it's a bull 2 times. Then you have Pfizer. PFES is a bear 2 times, and PFEL is a bull 2 times. So it's going to be interesting to see what type of volume these start to have and how they trade relative to the other things. Now, people never read the prospectuses on these things, but they should, because there's probably at least 30 different risk factors that you can read about. Because they use swaps, you do end up with counterparty risk, credit risk, and volatility risk. And for example, any one of these could go to 0, would be an actual risk. We did see that with some of the products that were volatility related in the past. And so it's always possible for that to occur again through various stresses on the market. So they don't, when you start to have leveraged instruments, the way they create the leverage is through derivative products, right? So there is an element of risk that you just don't have with a single equity. So just keep that in mind. It will be interesting, though. A lot of people like to play the inverse and buy them rather than have to go and get a locate and short or whatever. Sometimes there are no locates available for things from their broker dealers. So this could be helpful. So it's interesting. Another thing I want to bring out is we had the lowest sentiment reading in consumer sentiment in June was at 50, kind of a record low. And it popped up for July to 51.1. And so it was partially responsible for spawning the rally that we had on Friday. Also, cash and corporate buybacks. Cash is at a pretty significant level institutionally. There was a lot of deleveraging this year. And it makes sense because, the writing was a bit on the wall after we had such an incredible number of years, and we started to sputter already in September, and we bounced back, and then we sputtered a bit in December and kind of bounced back. And then and we started rolling over in January, and it's a whole new year and a whole bunch of other concerns. And then the war started, and so there was a lot of deleveraging. The institutions, they do move to cash more than people think, and so there's a lot of cash on the sidelines. And then there's corporate buybacks. These are companies that go, our stock's discounted. This is a great time to buy back our stock. We don't know if it's the bottom, and we aren't in that business of trying to pick a bottom. We just look at the relationship of maybe cash that we have in our war chest and the price of the stock, and we've already been approved for a buyback. So there's billions of dollars that have in buybacks that have already been approved, and these guys they have a window of time to do it. And so I see some of that coming through in the next 2 quarters here. So keep that in mind. One more thing, I'm concerned about this accountability issue with all of the money and the arms that are being sent to the Ukraine. I know, in previous times, there's a lot of emotional reaction to things. There's obviously political agendas, but this money is taxpayer money that's just going out of the U.S. to another country, and I don't know that there's a significant accountability trail for that. When I looked at what was going on in the Ukraine previously and all of the corruption, and you can read about it in the Pandora Papers, some of that stuff, it's just likely that there's going to be a lot of maybe misuse of some of that stuff. So, even though we would love there to be a peace agreement, we would love there to be some resolution, we would love maybe for the Ukraine to win against Russia. I just don't really see that as an option for a number of reasons, which I'll keep personal. But I just think that this is going to be a lot more dismal than people realize long term, and unfortunately, there's a real price that is being paid on a number of fronts, including what the U.S. taxpayer as well, right? So that being said, what do you think, Dave?
No, I mean, anytime you have large quantities of billions going out, I mean, it happened to Afghanistan too, right? I mean, how many billions went there? And everyone wants to be supportive of a country, or they don't want the refugees to go through this and that. But
I know. I mean, we want to do well. I mean, the U.S. has always been a very generous country, very helpful. But there's also political interests globally, and there's also a lot of weirdness going on. Like, for example, Saudi Arabia, for example, is buying Russian oil and using it for their own purposes, and they're selling their oil to the EU, obviously. So the thing is, these sanctions aren't, working in the way that they're intended. And Russia's meeting with Turkey and Iran, kind of forming a trade partnership there in a much bigger way. And, it's part of the purpose is to circumvent sanctions. So the thing is that there was lots of people that spoke up and said, sanctions don't work the way you think they're supposed to work. And yet the administration just continues to believe in sanctions, and the thing is, I can understand if you make a campaign promise and you say, well, we're going to do away with drilling in the U.S. and offshore, and we're not going to support it. We're going to be green. I mean, the future is the power of the sun, and so it's really tough to go back on that and to open up the supply lines that the U.S. has tremendous quantity of oil. The industry needs to be supported, don't you think? So, to then go and say, well, let's get it from Venezuela, let's get it from, Iran, let's get it from somewhere, let's get it from the Saudis who are buying it from Russia, okay. It's just like this world is getting weirder and weirder. You can't make this stuff up. If you wrote a novel, a fiction, you can't make this stuff up. I have to shake my head. I'm sorry. It's just crazy.
Well,
anyway, what's your thoughts?
We have a couple more things for the week. There's some key earnings and economic reports. So tomorrow there's earnings reports on Bank of America, IBM, Charles Schwab, Synchrony Financial. Tuesday we have Johnson & Johnson, Lockheed Martin, Goldman Sachs, Netflix. And Wednesday, Tesla, Johnson & Johnson, Verizon. So there's some big players that could show
and that's
us.
Very important. I mean, earnings are a big part of moving markets as well. And July is, like you said at the beginning of the show, July's been typically a positive month, a 2.6, 2.7% performance. And so part of that is, usually earnings season in July comes out pretty good. So I think in the oil patch, some earnings could come out pretty stellar. There are obviously some companies that are going to have FX charges, right? If they're multinationals, they're going to have currency charges that they have to apply, because if you were bringing in a lot of money from outside of the U.S., right, and you're converting it into U.S. dollars, you're going to have an FX charge because the dollar's so strong, right? So you're going to have some companies that horribly miss, but I think usually the leaders of the pack of earnings season have historically been pretty robust, right? It's kind of front end loaded with the ones that have the potential to do well, seem to be at the beginning of earnings season. So, yeah. What about economic reports? I think you.
Yeah. So there's some themes this week: housing and manufacturing. So on Monday we have a home builders index report. Tuesday, building permits and housing starts, and Wednesday, existing home sales. So first 3 days of this week, a lot of home building news and home sales that could drive some of the home stocks. And then Thursday, we have jobless claims. That'll show us if the economy is weakening at all, or it's just a really red hot economy. And then there's economic data for manufacturing. On Thursday, we have the Philadelphia Fed manufacturing index, and on Friday there's some U.S. S&P Global U.S. manufacturing. So two major themes: not homeless, housing, joblessness, and manufacturing will be kind of they'll shed some light on that with some of these reports.
Okay, well, it's going to be an interesting week, and it does fall between. It's always an interesting week, I find, when you've got, the following week is the full 5 days of month end, right? And so this week before can be very mixed anyway. So it's going to be interesting. Did you another question? Did you look at the James Webb Telescope pictures and stuff?
I saw just one of them. There's a podcast. I saw one of the images, but
I looked at all the images coming out so far. It's really interesting. Then I read about how they're being created, and I had to chuckle at myself a little bit. So it's infrared, right?
Uh-huh.
And so the images are basically, think of it as black and white sort of interpretive data, right? And so somebody has to take and color it all.
Yeah.
I read that and I thought, isn't that funny? So all that beautiful color that you see is somebody's interpretation of the data, right?
Yeah. Well, better make it look real good if they want to get more funding for the next project. Right?
We want more. We need another 10 billion for the next telescope. So let's make them real pretty. Yeah. Okay.
Well, I actually saw this telescope when it was being built in Northrop Grumman, and the thing is huge. I mean, it's the room with the people with the white suits and all, and this thing was massive. And it's really impressive what they did, and the beryllium coated, the gold coated mirrors, and so much money went into that. So they better make good looking pictures their next bit of funding.
Well, I know. I just had to laugh because it's like, well, it says it's an artistic rendition. It's our way of interpreting the data into these colors. So it's not like you going outside and taking an actual picture of, the mountains and the forest and the trees and the lake and the ocean, whatever. I mean, that's real color. This is anyway, it's pretty funny. Anyway, we'll end with that. Okay.
All right.
Take care of yourself. Have a great week.
Good luck. Thanks.